Hi, this is Daniel, and you're watching Unrivaled Investing. This is a no hype, mission focused channel trying to find you exceptional companies and unrivaled investments. Today, we're talking about Alibaba stock, which just reported their quarterly earnings. This is my favorite time of the year, folks, when we're talking about quarterly earnings 4 times a year. And the reason why I like earnings updates is because it tells you, okay, this is what the fundamentals of the business is doing, and long term fundamentals are what drive your returns as shareholders. Short term, you're going to have price action. Short term, you're going to have valuation changes, and everyone gets caught up in the day-to-day valuation and they lose sight of the long-term fundamentals. But that, in my opinion, is the thing to keep track of. And so when I see Alibaba post 30% plus revenue growth, significant free cash flow, buybacks that we're going to talk about in a minute, that is what I like to hear. I continue to be happy with my Alibaba stake, my ownership in Alibaba shares, and I continue to think it's a very attractive risk reward. I did post a video earlier on Alibaba a few months ago that's a deep dive video. So if this is your first time tuning in, I would check that video out first just to get a better understanding of their business model. This is the quarterly update to see, oh, okay, how is Alibaba doing on their journey, and am I happy that it is part of my investment journey? If you want to learn more about my personal investment journey, go to unrivaledinvesting.com for my full portfolio. Let's dive into what's going on with Alibaba. Once again, that video, Alibaba deep value question mark, that is for the better understanding of, or deeper understanding of, their business, because there's a lot going on here. This is a behemoth of a company. And so going over their quick earnings result summary, you're looking at 34% revenue growth, 22% if you back out a very large acquisition of SunArt. Then if you're looking at, the platform, this is still a huge platform. 912 million consumers in China use them. 265 million users abroad using their international platforms like Lazada or AliExpress. Their profitability did take a hit, down about 11% year over year, but this is a reinvestment year as they want to lay low when the CCP is watching. When the CCP, or the Chinese Communist Party, is making a point of checking out who are the potential monopolists, who are the ones with big, fat, juicy profit margins that might be squeezing the system. This is a good year for Alibaba, and it's been fully expected that they're going to be reinvesting in this business. We'll talk about what they're reinvesting in just a minute. And not only did they put up solid growth, in terms of 30% plus growth, 20% X acquisition, they're returning the cash to shareholders. Here it is. Since April 1st, 2021, through the publication of this results announcement, we repurchased 18.1 million of our ADSs, American Depository Securities, for approximately $3.7 billion. And then they decided to upsize their company's share repurchase program from $10 billion to $15 billion. And so when you think about $15 billion repurchase, let's say they could do this on an annual basis against their current market cap, that's about a shareholder yield of around 3%. So that is what shareholders are getting. It's not like a dividend where, you actually get the cash, and that's, I would argue, a tax disadvantageous way to do it, where you have double taxation. This is much preferred because you aren't taxed the second time around. You're just taxed on the initial profits, and then, hey, you can buy back the stock. And so I much prefer seeing buybacks at sensible prices like what they're doing. So a shareholder yield of about 3% plus significant double-digit growth. You're talking about, let's say, 20%, organic growth in this quarter. That's fantastic. I look at this as a great use of capital. This, a lot of people don't expect this type of buyback. They say, oh, China's never going to return, capital to shareholders. $15 billion is what they're penciling out. 3.7 billion effectively in the last quarter. And honestly, when I look at this, and a lot of people have sort of a gag reflex when I say this, but it would be great if the stock dropped a lot lower and they kept buying back stock. I mean, the more the share price drops, if they continue buying back $15 billion a year, that means they're going to be buying back more and more shares from, paper hands, from people that are effectively saying, oh, okay, the price is going down, therefore it's a bad deal. If you have a company that consistently buys back $15 billion worth of stock, and it keeps dropping, that means your relative share of the stock, your relative share of the business increases. So, in theory, if something drops 90% or 99%, and you're able to buy back 15 billion, it's gonna be me and Jack Ma owning shares in time. Now that's obviously an exaggeration, and that's the reason why things generally don't drop 90% plus when you have a significant buyback in place like this. But that's, what I do like to see. So as long as this company is as healthy as it is, generating this much cash flow, I'd love to see, the stock drop lower and them to keep buying back shares. I love seeing this, and this does resonate with the fact that they think this is potential bargain territory with the share price. So let's dive into these, the actual understanding of their segments. So their core e-commerce business, so their China commerce retail segment, their customer management segment, that is their core juicy business historically. That's like effectively the fees, the commissions off of every sale across their various different platforms. That's only growing about 14%. So that is not super fast growth relative to all these other business lines, but it's important to recognize that all these other business lines generally have much, much lower margins. Think of like an offline grocery store that's going to have much, much lower margins than, let's say, this core customer management segment that's effectively the merchants paying to be on the platform, the fees, the charges for being on the platform for every sale. This is a 40-50% growth, operating margin business line, very fat margins. Everything else, very low margins, or tougher margins, I should say, where they haven't necessarily proven themselves out yet. We'll talk more about that in just one second. And so then if you look at on a consolidated basis, these are all their different business lines that go into just their commerce segment. So this is just shows you how complex Alibaba is. You're looking at so many different moving pieces. But their consolidated commerce business grew 35%, but only 22% growth if you exclude their Sun Art acquisition. And the way to think of Sun Art is, it's a hypermarket grocery chain. It's one of the largest in China. This was about a $4 billion acquisition earlier in 2020 that Alibaba made to enhance their offline presence. So that way you can have this omni-channel presence, both online, offline. You can order online, pick up in store, that sort of thing. And they're rapidly growing their other segments, such as their international commerce segment. Lazada posted something like 90% growth. You can see how that translates. International retail growing 54%. Their logistics segment up 50%. But once again, international hasn't proven out its margins yet. You have stiff competition, so you're going to have much lower profit margins for now. And if this business line grows relative to, let's say, their core management segment that's already very profitable, you're going to see profit margins go lower. Same with logistics. Logistics are probably hugely unprofitable, especially relative to the other players in the industry. So that is something to understand is, okay, you have this like 40-50% profit margin business that is slowly losing relative share relative to these other business lines that are growing quicker, that are either unprofitable or will be profitable longer term. And so that's what it's important to understand. And so when you think about those margins, you can see it clearly here, where in June 2020, the quarter, they had about 38% EBITDA margin. That's earnings before interest, taxes, and amortization. They add back share-based compensation. I personally don't. I view that as real expense. That said, the amortization, adding back the amortization of intangible assets, that is a fine add back. So I am comfortable with that because that's not truly a cash expense. And so here it is. You're talking about a mid-30s% EBITDA margin, and compared to now, the most recent quarter, it's only 25%. So that's a huge drop, but in all honesty, that's what I expected it to shift to over time. And my previous margin assumption that I called out in my previous video for the commerce segment was effectively 17.5% to 22.5%, I think, which I'm trying to bake in some conservatism, but will have, lower margin mix because of, let's say, the hypermarket and logistics that I just talked about, along with shorter term investments they're making. For example, they have this new platform called Idle Fish, which is effectively selling secondhand refurbished good marketplaces, consumer to consumer, or in reinvesting in community buying programs. That's been a hotter trend in China in the last few years, fast growing, taking share in the e-commerce space is community buying. And so, yeah, Alibaba's margins are going down, but you should think about that when you're valuing it, when you're thinking about what their margins could look like in the years ahead. And so then so we talked about their commerce segment. Then the next question is, okay, so what about their other core segments? Because a lot of folks are hot to trot on Alibaba's cloud. Alibaba's cloud, this was a point of disappointment in their quarter where they only posted about 29% growth. A little disappointing, but They're still the largest cloud player with about 40% share. Why didn't they put the 40 to 50% growth that I previously expected? And it's largely due to the headlines, effectively, and the concern that one of their top customers, ByteDance, dropped Alibaba for their business outside of China. Keep in mind, ByteDance is the owner of TikTok. This might have been part of the thought process of, hey, TikTok doesn't want to get shut down in the United States, so we're going to say, hey, we're going to use a cloud vendor that's, let's say, not China related, so that way we can say, hey, we're not controlled by Beijing. That's sort of, I think, the thought process that went on here. But that did have a big impact on Alibaba's cloud's growth. If you had excluded this aspect from their business, it would have been growing about 40% year over year. And what's critical to see is, despite this sort of growth slowdown, on a profit margin basis, they're getting much, much closer to break even, this cloud computing segment, getting closer to break even, which is what I like to see. Now, here's another key segment, their Ant Group, which got a lot of publicity. One could argue this is actually what set it all off, was when Jack Ma effectively said, hey, CCP, bank regulators, you don't know what you're doing. And on the eve of Ant Group, Ant Financial going public, and this is, Alibaba's digital wallet, that they own about 1/3 of Ant Financial or Ant Group. And on the eve of going public, the regulator stepped in and said, this is you can't talk smack to us telling us, we're doing a poor job. We're going to, talk some sense into you. Jack Ma effectively disappeared. And a lot of folks said, oh man, that's the end of Ant Group. This is, this business, which would previously valued somewhere between 150 and 200 billion dollars. Now they're saying, this is just going to lose almost all of its value. It's going to be regulated to zero. That was the concern. And you even see that today, where here it is sort of as a Rorschach test, the Bloomberg headline about Ant Group saying Jack Ma's Ant sees profit slide 37% after a regulatory setback. I love this because that's almost like a Rorschach of how investors are thinking about Ant Group. Because the reality is, if you compare this quarter to last year, not this quarter to the most recent quarter, so comparing effectively June to June last year, their profit was up 50%. Versus comparing June to March, then you're saying, oh, it's down significantly. And that's the part that blows me away is, yeah, this business is still a behemoth. It's still growing billions of dollars in potential profit over time. Honestly, better than I expected. So I think the valuation for Ant Group should potentially still be in the, let's say, $100 to $150 billion range when I think about it. Maybe even more if they just, keep growing into their valuation, maybe expanding their valuation over time. And so what are my thoughts on the valuation? Keep in mind, this is a pretty quick overview of their earnings. There's a lot more ground to cover, like their digital and media segments. I'm not gonna be able to do that in this video, but the goal is to look at the big piece of what's driving valuation. So let me do a quick plug here. Or once again, if this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing. If you enjoy learning about potential multi-baggers, types of stocks that could potentially go up hundreds or thousands of percent over time, please make a point of subscribing, hitting that thumbs up. If you want to follow my personal journey as I look to find these potential multi-baggers, go to unrivaledinvesting.com. First week of the month, I call out my full portfolio, what I'm buying, what am I selling each week. I call that out, and by the end of the month, I call out at least one potential multi-bagger. In my view, is just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey as I call these out, go to unrivaledinvesting.com. Let's dive more into understanding Alibaba's valuation. And so this, keep in mind, was my original analysis as I thought about them. Since then, the stock's down about 20%. And I previously thought, this was from my April video, I effectively said in 5 years, it's possible in my low case that effectively the stock price doesn't go anywhere. So nothing that's happened since then has said, Daniel, oh my gosh, you're all wrong. That's not the case. I effectively said, look, you could pretty much break even over 5 years. That was my downside case. And then my upside case is, you know what? You can get potentially a 28% annualized return. And keep in mind, this is a hypothetical framework. Of course, the stock price could go higher or lower, but this gets back to my opening point. I want to judge companies by their fundamentals. Day to day, people go, oh my gosh, this stock's down 20%. Look at you. You were wrong. And I'm like, the valuation came down, but I own a business that just grew revenue by 34% and announced they're buying back $15 billion worth of stock. So I'm happy with my ownership. You don't see me selling the stock, and I'll let you know if I capitulate. I'm like, oh my gosh, I was all wrong. I'll do a video on that if I am. But at this point, I'm saying, like, I'm I'm sitting pretty. I'm happy with this. I'm not, like day-to-day volatility down 10, 20, 50. I'm comfortable with that, especially if you have huge buybacks in place. So this was my original analysis. Now, updating the analysis a bit, thinking about, hey, I need to layer in the cash on their balance sheet. I'm going to up their Ant Group, their Ant Group investment a bit, just based on seeing their latest results. I'm going to narrow their core commerce segment in terms of what that range of profitability could look like. But either way, when I look at it now with a lower stock price, I'm effectively looking at something on an annualized basis where I'm effectively penciling out maybe 50%, because 50% over 5 years is about 9% annualized return, about to, let's say, 300% plus annualized return. 300% total return over 5 years, about 35% on an annualized basis over 5 years. That's how I'm looking at this thing over the next potentially 5 years, where I'm saying, man, this is now even potentially a better setup now that it's down 20%. I know they're returning significant free cash flow to shareholders. I still think that this business has legs, can continue to grow. So I'm effectively saying 50 to 300% upside. Of course, could I be entirely wrong? Could it go lower long term? Could it go lower in the short term? I certainly think it could go lower in the short term. If you have some sort of geopolitical event, if you see delisting fears pop up, that could drive short-term pressures, drive it lower. But long-term, I'm not selling this until I see a fundamental impairment in their business model. And I see this as, wow, look at the growth across all these different segments where they're growing their top line. Yeah, sometimes their profitability might take a hit because they're reinvesting and launching new platforms that can grow even faster. But I like what they're doing, and they have a history of investing in new platforms that generally pay off. New initiatives that pay off. So I like what I see here. I like the free cash flow. And look, understanding that this is just one bet in my portfolio at unrivaledinvesting.com. I call out each month potential new multi-baggers, where usually I'm calling out saying, hey, I just bought this. Here's why I think like maybe my downside over 5 years, maybe I break even, but over 5 years, maybe the upside is like a couple 100%, maybe even 1,000% over time. So like Alibaba is just one component. My Chinese bet, a couple of different companies, about 25% of my portfolio. The vast majority of my portfolio is not China. I just recently thought like, hey, you fish where the swim are. You fish where the swim are. You fish? Yeah, you fish where the fish are. There you go. And so fish where the swim are. That's pretty ridiculous. And so you fish where the fish are, just because, that's where the opportunities are. And that's what's happened with China lately, where, Chinese stocks have just gotten hammered over concerns with regulatory shakeups. A perfect example is just recently, in the last day or two, I don't need to make a whole separate other video about this, but like Tencent stock dropped about 10% overnight because of fears that the CCP was going to regulate their gaming business, particularly with a focus on younger individuals that are spending money on their games. And like losing 10% on a business that's like a $600 billion market cap, $500-600 billion market cap, that was effectively losing $50 billion. And the part that blew me away about this is that Tencent knew that they would be regulated and that there would be more regulatory concern regarding young video game players, under 18. So they called out in their annual report that something like 3%, it's somewhere between 3 and 6% of their video game revenue was tied to minors, and something like 3% or 2% was from under 16. So I view this as like a fraction of their business could potentially be effectively wiped out, like 1 to 2% at most. And I'm thinking, that's what drives $50 billion loss, in market cap for this stock. So that's a perfect example of thinking about like, wait a second, you need to separate what's fundamentally happening versus what's the emotions, what's the price action, what's the valuation change. And that's why it's so important to track quarterly earnings like this to see, okay, what's actually going on with the fundamentals of the business. So quick recap on Alibaba. I like what I'm seeing so far. I continue to see solid fundamental growth with this business. And even if you don't want to get into the weeds of analyzing like the individual segments like I did, just a ballpark think about it. Like if you have a business that's growing, let's say 15 to 20% a year, even if you don't have any valuation expansion, Meaning people like you never get a better multiple. People never assume like, hey, this business quality is better than it is right now. So whatever concerns you have, that stays. So the valuation multiple stays the same. If you just have a business that's growing 15 to 20% a year, you would still have an attractive return over time, especially if they're returning, let's say, 3% cash to you as a shareholder each year. So I just look at this as like quick back of the envelope. I still like the risk reward with Alibaba stock. If you think I'm nuts or Daniel, please just stop talking about China stocks. Leave a comment below. I'd love to hear more about your journey in the comments. Thank you so much for watching.